The IPO market has been slow, but Piper Sandler's Dave Stadinski believes companies are starting to gain more confidence that they can execute a successful IPO. We'll talk about that and more on the next episode of the Pipeline Podcast. Hi, I'm Joe Mantone, an editor with S&P Global Market Intelligence and the host of the Pipeline Podcast, where we talk about all things deal making. On this episode, I speak with
Dave Stadinski, Global Co-Head of Equity Capital Markets at Piper Sandler.
Dave has more than 25 years of experience in the investment banking industry and has spent much of his career as a capital markets banker, advising across many industry sectors. Dave said the current downturn in the capital markets is the longest in more than 2 decades. He explains why it's been worse than what we saw during the great financial crisis and points out a common theme among the companies that are going public. I started off our conversation by asking Dave if the IPO market has been slower than expected this year. IPO market this year, how has the activity been? Has it been what you expected so far?
I think it depends on whose expectations we're measuring. And what I mean by that is we've looked back at the prior 25 years, Joe, of just volatility-induced capital market slowdowns. There have been 5 of them, and we're now in the 6th one in the current period here. The longest was global financial crisis. That was 6 quarters. And the shortest was COVID. That was only 1 quarter. It was a sharp move down, V out, and then pretty meaningful capital raising. In this current period, we're about 7 quarters in, and broader capital markets activity really is beginning to pick up. We're seeing convertibles lead the way, which tends to be the case when you come out of periods we've been in. There was something like 18 billion of issuance so far in Q1, and then follow-ons in formats like wall cross deals and pipes, which added something like another 40 billion on the year. But those are the areas that lead the way out, and many times the IPO market's the laggard, the slowest to come back. By that measure, we really are experiencing a fairly typical pattern of recovery, and some of the recent deals are evidence of that.
So I'm sorry, you said we're 7 quarters in, and what was the drop off after the financial crisis?
It was 6 quarters of below trend capital formation during global financial crisis. The current period here, the slowdown we've been in, has been about 7 quarters now, and we're starting to find our way out of it through the trough.
So it's been worse than the 2008 crisis.
In terms of volumes and issuance, it has. Yeah. In terms of duration, from sort of normal levels to trough levels, it is the longest right now over the last 25 years.
Wow, that's a bit surprising, right?
Yeah, surprising, but maybe not so when you take it in the context of the liquidity-driven period of 20 and 21. There was a lot of capital around, a lot of companies raised money, maybe more than they expected to. And on some measure, there was a delay in returning to the capital markets. I think we're coming back on trend now, though.
Okay. And then you mentioned convertibles. Why do convertibles typically lead? Is it just because of the debt-like features?
Speed to market, convertibles also capture volatility in terms of how those instruments are priced. They tend to be for more developed companies versus maybe earlier stage companies. So there's already a trading market, a known business model, and the speed coming to market really underpins that as an instrument to lead the way out of periods like we've been in.
Interesting. Okay. It all makes sense. And then getting back to the IPO market, last year we saw a couple of IPOs that generated some buzz, the ARM deal, the Instacart, but the momentum for others really didn't pick up after those transactions priced. Why do you think that was the case?
Yeah, so I'm trying to think back. I think ARM and Instacart were each about 6 months or so ago now. As it relates to ARM, you may recall at the time the semiconductor names were actually softening from late summer into the fall period, and the broader based AI buzz was just starting. So it was a different market. There wasn't that immediate or near term market follow through off of each of those financings. As I recall it, Instacart did have some momentum into the offering. I believe, going from memory here, it was priced above the high end of an upwardly revised range and initially traded up, but then had a little bit of softening for a period of time. But both of those names now, I should note, have regained positive share price performance and are trading higher and notably arm around the AI excitement.
Right. Yeah, and then so this year we've seen at least one high profile IPO in the Reddit deal. Does the market need some real buzzworthy IPOs to pave the way for more going public transactions to occur?
I think it helps. And probably as a reminder to your audience, Piper Sandler was an underwriter in the Reddit IPO, and we're still in the 25-day quiet period. So probably should keep my comments to a high level. But I would just say anytime you have a higher profile, widely recognized name, the deal is going to be followed, written about, scrutinized. And I think in that particular case, the company has a large following just beyond the institutional marketplace by way of their active user base, which likely also contributed in some way to the buzz around the IPO.
So that deal and also the Astera Labs deal, both of those companies saw their stock prices jump in the first day of trading. How important is that after-market performance for the rest of the IPO market?
Yeah, you're citing two. So in the case of both Stera and Reddit, they were both relatively large IPOs. I think it's probably important to know that. Speaking in round numbers, around $800 million each in offering sizes. So it was good to see the liquidity and the strong aftermarket follow through. In the case of Astera, that part of that first day jump may be attributed to the underlying demand for companies with exposure to data center infrastructure and AI semiconductors. But how that affects maybe your question more on what it means for future deals. Is that a way to interpret your question or what?
Yes, that's really the important piece.
Yeah, I think the recent deals are almost always considered as data points, but among many data points that both underwriters and stakeholders consider, whether that's technical or fundamental, whether it's things like the overall market environment, line of sight to demand, test the water feedback, growth margin profile, and probably many other factors that come together to determine sentiment around a deal. Each deal really needs to stand on its own and be evaluated independently, but some of the recent peer benchmarking data certainly plays a role.
And that could affect the pricing of future deals.
Talking about just IPO pricing, perhaps, typically IPOs are thought of as coming to market at some discount to the peer public comparable group of companies. Let me give you an example. If the peer group is trading on average, Joe, at around, say, 6 times forward enterprise value to revenue, the IPO of a company in that particular peer group might price at, say, 5 or 5.5 times EV revenue, known as the at pricing versus the fully distributed multiple. And so you say, why is that? And part of the reason is well-seasoned publicly traded companies have already developed a liquidity profile, already established some valuation levels based on information that's known in the marketplace. And by definition, a private company coming public for the first time, there's just less information around the IPO about the company, but that tends to have a gap that's closed over the case of a couple of quarters or years, once you become a public company.
Yeah, that certainly makes sense. And then so I believe I've heard in the past that a 10% increase on the first day of trading after an IPO is the optimal increase in stock price that companies want to see. Is that the case?
I think it's what I was just really commenting on. I think you have to look at the peer group, the valuation metrics, and then so what is the inducement for an investor to come in and purchase the IPO as a newly issued security? It's that gap in information that creates that little bit of a discount. Maybe you can think of it as trading up on that 10% that you're citing. I view it more as the pricing at pricing multiple versus the fully distributed in the market post IPO.
Gotcha. I see. And then so are there any lessons learned so far from the IPOs of this year for what it takes to have a successful?
Yeah, I'd say not even this year, but one of the things I tell clients is listen to investor feedback. That information that's learned along the way through the many meetings, the late stage private meetings, the test the water meetings and the like, was the story you're telling being heard in the manner you intend? Are there any mid-course corrections in how the story is being positioned? The empirical data suggests that the propensity for an investor, Joe, to convert into an order book and to do so with conviction tends to be much stickier if that team has had an opportunity to meet with management before the IPO roadshow, right? Several impressions even before the IPO roadshow, even better. Companies' long-term investors are going to think like owners, like partners. And so they know it's imperfect really at the time of the IPO, but when you've organized an effort and you're trying to find that fair level where buyers and sellers can come together at a point in time, that can always create a little bit of noise around the pricing of whether it's your 10% assumed appreciation from the IPO or just in terms of the overall demand. But the investor feedback and the information that a company can learn and its advisors through all those impressions leading up to the point is a really critical point in learning how you can bring together buyers and sellers.
Has that feedback on recent IPOs, has that led to any sort of different terms or deal structures that we've seen?
I don't know if it's different terms or structures, but I would just maybe comment that many of the IPOs that are coming to market already have some line of sight to demand, or in some cases, existing investors indicating their intention to participate or in support of the IPO. That's been a trend that's been developing the last few years. It has been important for giving management teams, boards confidence in terms of where demand may materialize in the IPO, the so-called pre-identified demand. And the corollary, of course, to that is that demand is being taken up from existing investors on some level, which leaves less available shares for new investors to come into the order book. And if it's meaningful enough, that could be a deterrent for a larger group to both evaluate the opportunity if they're thinking that they won't be able to obtain enough shares to make the effort worthwhile. So it's a balance. You want that line of sight. You want to have some confidence going in, but you also want to have enough new shares available so that you can fill out your order book with a high quality group of investors.
And then looking at the calendar, are there any sort of potential IPOs that are in the pipeline that you have your eye on that might generate some buzz for the market as a whole?
I might answer it this way. There's something like a dozen names, could be 15 now, not quite sure. Haven't looked at it the balance of this week, but that are on file publicly, meaning available for everybody to see the S1 that's been filed and that the company's intention is to move forward with an IPO. But I'd submit to you, there are many more names, even beyond what's in the publicly filed backlog, that are in the waiting, that are not yet visible to the public. And if the recent performance of IPOs continues, then it's our belief that a number of these companies that are on file confidentially may consider advancing perhaps even earlier than they might have thought just a few quarters ago. It was only 6 or 9 months ago, Joe, where many companies, clients we were talking to were making plans for being private longer because there just wasn't good line of sight for activity and receptivity in the public markets. But I think some of that's starting to change. And if the next class comes forward and has some successful offerings, prices, trades well, has good excitement around it, I think that you could see other companies contemplate moving their timelines up perhaps earlier than they might have been thinking.
Yeah, that's interesting and good to hear. The Fed recently, after the last meeting, signaled that it's still on track to cut rates 3 times this year. Do you think that has factored into any of your clients' thinking about going public at all?
The Fed has obviously had some dovish comments. The market has been trying to interpret the pivot to perhaps the short end of the curve with rates coming down. But if you look at risk assets and stocks as a proxy, the market has looked through that and has continued to perform in many cases with stock prices advancing at or near all-time highs. The smaller cap companies haven't participated as much in those near-term rallies. So if there was one area maybe to focus on that perhaps could have some more interest rate sensitivity, I would say it's the earlier stage growth companies, where if rates were in fact lowered, that might inject some additional excitement into the smaller cap names that haven't participated nearly as much as the larger cap have in the recent past.
But we need to see actual cuts and not just the expectation of cuts.
I think the market's already, and you've said it, right? Anticipation. So it's always going to be forward looking. So by the time, if and when the cuts do happen, markets will likely have moved already based on that anticipation.
And then Powell did indicate that inflation will come down more gradually than previously expected. And I know that there's some consumer IPOs that are on the calendar expecting to price this summer. How much of a deterrent can inflation be for companies looking to go public?
Probably plays some role. Consumer has been one of the industry groups that has been less active. When you look at all the groups that are coming forward and accessing the capital markets, really healthcare has been, technology, even the energy space is seeing a little bit of a resurgence here. And consumer has been notably absent. Perhaps inflation and how companies manage based on consumer behavior and consumption patterns and labor costs are a factor there. But you're right. We haven't seen that much activity in the consumer space. And there's probably something to your question there as it relates to inflation.
But do you expect that to change? Do you think we'll see more consumer activity?
I'd like to say yes. I don't see it in the immediate near term. Now, that isn't to say in 3 months or 6 months' time, we couldn't be in a different place. But right now, I think what you're likely to see is more activity coming forward in the healthcare, biotech in particular, but also in the technology space. That's where you're going to see more of the action coming up in the near term, Joe.
Okay. All right. Okay. That all makes sense. Dave, I appreciate you taking the time with us here today. Thank you very much.
Yeah, my pleasure. I hope it's helpful to your audience in some way. I appreciate the opportunity.
That'll do it for this episode of The Pipeline. Thanks for listening.